Good morning, everyone. Welcome to this webinar on the tax planning strategies by Fortuna Advisory Group. My name is Dinesh Aggarwal, and I'm the Managing Director of Fortuna Advisory Group, and I'll be presenting this webinar today. Just to make sure that everyone can hear the audio perfectly, please confirm by a message on the chat. If you have any audio issues, please let me know. Uh, while I go through the presentation, feel free to ask any questions through the chat messages. And I'll try to answer them as I go through the presentation, or I'll try endeavor to answer them towards the end of the presentation. So let's get into it. So just a little bit about Fortuna Advisory Group. Those who don't know us, we are a multi-service accounting practice with dedicated divisions in tax and business advisory, financial planning, mortgage broking, and legal services. Offer a comprehensive and a holistic solution to all our clients, and bring you on a journey with us to help you to grow your business and achieve the financial freedom through our various divisions and skill set under our practice. We are a multi-award winning practice, some of the prominent awards being the Best Multi-Service Firm of the Year in 2019 by the Australian National Accounting Awards and the Best Boutique Advisory Firm in 2020. So the topic for today is the tax planning strategies, and I'm going to focus on the key 5 strategies today. Just let's start with a little bit concept about tax planning. What does that mean, and what are the legitimate ways of planning your taxes and minimizing it under the legislation, and why that is important, especially close before the end of the financial year, so that you can optimize your tax solution. So the tax planning in principle is basically a legitimate method of bringing a tax efficiency, which means that you use the legislation. What are the effective ways in the tax legislation to optimize your tax by applying various strategies through, of course, all legal acceptable practices which are under the law. And so it's distinct from tax evasion, where you basically applying a methodology to reduce your tax, which is not legitimately accepted in the tax law. There are certain things which are not very clear in law sometimes, which sit on the fence or they're gray, and then you have to go by the interpretation. In those situations, we normally look at how the tax office has interpreted the law. Have they issued any ruling or guidance on that particular subject? So if there's any clarification by the tax office, we normally try to take their view that before we make sure that what we're applying is going to be accepted by the ATO. Because if that's challenged, then you're basically going into a legal debate with the ATO. But sometimes we do take a view against the tax office if we have a strong interpretation of the law, or we take a legal opinion and we think that's we legitimately applying that to optimize your tax situation. And we are very confident if the tax office takes a different view, we can actually go for an objection to the commissioner, or we can go into further appellate process through the administrative tribunal, or even go to the court if it's material enough to fight that. So why we look at the tax planning? Of course, the most important aspect is to get an optimum and the best tax outcome for a taxpayer, whether that's a company or a business structure, or as an individual or as a business owner. We have a marginal tax rate system in Australia, which means as progressive taxation. So as you earn more, you go into a higher tax bracket. That means you need to pay a higher average rate of tax. In some of the recent budget announcements, as some of you would know, the federal government is trying to balance the marginal tax rate systems. They've promised to bring the topmost marginal tax rate down from 45% to 30%, and that will happen progressively. They're also changing the marginal thresholds of income to which the various marginal tax rates apply, and I'll touch on that a little bit later in the presentation. So what basically the lower taxes, what does that mean for you? That means if you have a lower tax to pay against your assessable income, your disposable income in your hands increases, you have a higher cash flow, you can invest that, or you can have basically your cash flow improves, you can invest in your business, or your power to spend, or that improves as well. So the tax minimization strategy generally doesn't work in isolation. Most often you have to combine that with some sort of an investment strategy, and we'll discuss that a bit later, how that works. I mean, some of the examples are like superannuation is one of the very popular tax optimization strategy, but that means you have to block your cash flow by contributing more to the superannuation, which then has to be invested for a long-term return or towards your retirement goals. But if you don't want to lock that in for a longer period of time, then you have to look at what are the other investment opportunities outside the superannuation that can help you to minimize tax, like investing in properties, which can give you a negatively geared outcome, but overall has a higher capital appreciation over time. So let's start with our first main strategy today, which I will be covering about the instant asset write-off, temporary full expensing of depreciation assets, and accelerated depreciation. There are three main concepts here. Now, that is because it has how it has evolved over the last 12 months. Most of us running a business are familiar with how uh, the federal government has been announcing the instant asset write-off in the last few years, which has over a period of time has increased from $1,000 to 20, 25, 30, and then went up to $150,000 during the COVID time. And then some further legislative changes have been made where this cap has been removed. And I'll discuss these in a little bit more detail, how they differentiate with each other, and what's going to be relevant for 2020 and 21 financial year and from going forward, because this particular financial year we are in, which before 30th of June 2021, all the three are relevant because we got three different dates to consider based on your acquisition of an asset, and which particular provision will apply for you to claim either the instant asset write-off or one of the other two, which is the temporary full expensing or accelerated depreciation. So I'll explain that now one by one. So let's look at the instant asset write-off, which was already there in the previous financial year. Got extended. Originally was up to 30th of June 2020, got extended up to 31st of December 2020 with the asset. So it has to be purchased by 31st of December, but you need to have it ready for use or installed before 30th of June 2021. Now, under that old provision, if you are buying an asset up to a value of $150,000 for business use, including any vehicles that were eligible for an instant asset write-off, so you can claim the entire $150,000, subject to a couple of restrictions, which we'll discuss, especially on the luxury car limit. So the eligibility was that the asset has to be, individual asset has to be under $150,000, both eligible for new and second-hand assets. And some of them were excluded, for example, assets which go to a low-value pool, which is under $1,000, and some businesses who are still using that low-value pool. Horticulture plants, like including the grape wines, and softwares which go into the software development pool, and capital work deductions, which is basically your buildings which get depreciated at a different rate because that falls under a different section of the legislation. So you claim that at a 2.5% depreciation on your building. So that's not covered under the instant asset write-off. So the eligibility from the dates perspective was that you should have acquired the asset after 12th of March 2020 when this was originally announced. And because it got extended in the budget in October 2020, you could have it ready for use before 30th of June 2021, which is the end of this financial year, but needs to be purchased by 31st of December 2020, which is the end of last calendar year. So any asset purchased prior to that date was still eligible for a threshold of $30,000, which is irrelevant for this year because that was all pertaining up to 30th of June 2020. And the turnover of the business had to be limited to $500 million. Anyone above that was not eligible for that. Now, when I discuss about the temporary expensing provision, which is the new law, you'll see that to some extent this becomes irrelevant after a certain date, but it's still relevant for people who've already acquired assets before the budget announcement on October. So 6th of October 2020 is a very relevant date from this perspective in this particular financial year. And it's up to 30th of June 2023, which is has recently been extended in the current budget from 2022 to 2023. So I'll explain that a little bit more now. So in October 2020, when last year the full budget was announced, they introduced this new provision called temporary full expensing of the business eligible assets, which means they made it uncapped. So you can instant asset write off, but an uncapped amount. So an asset to any value for businesses up to a turnover of $5 billion. So it's quite a wide range. There is no cap of $150,000 that applies under this particular part of the legislation. So some of the concepts, what are the eligible businesses? As I said, $5 billion turnover. The turnover has to be calculated as an aggregated turnover, and the definition for that is same as you use it for calculating the small business entity concessions. Primarily, you need to aggregate if there are multiple entities in the group. You need to aggregate them for calculating the aggregated turnover for this purpose. Now, under eligibility of the assets, you can buy a new or a second-hand asset. The only restriction is that if you're buying a second-hand asset, then your business turnover needs to be below $50 million turnover. That means above $50 million turnover business, you are not eligible for this deduction for a second-hand asset. You will be for the new asset, but not for the second-hand asset. Now, the asset needs to be acquired after 7:30 p.m. Australian Eastern Standard Time from 6th of October 2020 onwards. And it needs to be ready for use or installed prior to 30th of June 2022. That was the original announcement till this new budget, which has been announced a couple of weeks ago, that has been extended by another year. So that takes you up to June 2023. Some of the exclusions under this provision are that, again, similar to instant asset write-off, that assets allocated to a low-value pool or a software development pool have to be excluded. Some primary production assets, buildings under the capital works, as I explained, that fall under a different section, which is the capital works deduction. You get depreciation at 2.5%, so they get excluded. And any assets that will not be located in Australia or would not be used principally in Australia for a business being carried here in Australia. So further, a little bit further into temporary full expensing provisions. Now, what if you have an existing asset and you make improvements to that asset? So if it's an existing asset before 6th of October 2020, that will be considered as a second-hand asset. but you won't be able to claim the full value of that existing asset because one of the conditions is that asset has to be acquired after 6th of October 2020. So you can't claim the original cost of that deduction, but the legislation says that we will consider that asset as a second-hand asset because you've already used it. So you can't fully claim it, but for the purpose of any improvement you make on that asset will allow you to deduct the full amount of any improvement to that existing asset. Let's say if you have an existing machinery or a big piece of plant and you add certain significant parts to it, so you'll be eligible to claim any improvement on that asset made after 6th of October 2020. But if your business has an aggregated turnover of $50 million or more, then you can immediately deduct the business portion of the cost of improvement on asset, which then otherwise would have been excluded because it's considered as a second-hand asset. So you have an option to opt out if you don't want to claim a full deduction under this provision and you want to claim the depreciation as per your normal rules, which you can do that, but except if you are a small business entity and you are using the simplified depreciation rules, which is the pooling of the assets as your normal small business who's eligible under $10 million turnover, they can pool their assets and claim 15% in the first year and 30% in from the second year onwards, and everything is pooled. So if you're using those simplified depreciation rules, then you don't have the option to opt out. You'll have to use these provisions for immediate instant asset write-off or full deduction for these assets, and anything else if you want to put it to the pool or is eligible to go to the pool will go to the pool, or otherwise rest of your pool will carry forward unless the pool can be written off if it's below that certain value. You need to inform the tax office by a particular form before lodging a tax return if you decide to opt out of this particular deduction. Now, as I mentioned earlier, there is still a restriction under all of these, even the instant asset write-off, and the same concept applies to the temporary full expensing provisions, that if the value of the vehicle, which is below 1 ton or up to 1 ton, carrying less than 9 passengers, is considered as under the luxury car limit provisions. That means you can only claim the depreciation or a full write-off up to the extent of that luxury car limit. So we'll explain that by way of an example here on the screen. Let's say if you buy a car for $100,000 excluding GST, and that's before 6th of October. And I've taken that for ease because that's a relevant date here when the actual few new things have been introduced. So the delivery of the vehicle has been taken before 30th of June 2021, and the car is eligible for instant asset write-off. So we assume that the car has been purchased in the name of a company or a trust, because if it's a sole trader, I'll discuss that sort of a little bit down the slide, you'll see. It needs to be used 100% for the business use. And because in this example, the value of the car is above the luxury car limit, which in this case for June 2021 financial year is 59,136. So value of the car above that, that means you're only eligible to claim a deduction for 59,136. So there's two aspects to look at here. So first of all, to be eligible, the value of the asset has to be below $150,000. So that's the first condition. If you go above that, you're not eligible at all. Then the luxury car limit, concept doesn't apply because you're not eligible at all. So if it's below 150, that you pass the first test, you're eligible under this rule. But because it's a luxury car, limit applies to it, and then you capped to that amount of 59,136. In this case, the balance out of 100,000 will sit on your balance sheet as a non-depreciable portion of the value of the asset, which will just sit there and you can't just write that off. But just keep in mind that if there's a private use of the vehicle, you still have to calculate fringe benefit tax for the private use portion, in which case the whole value of the car is considered for the calculation of the FBT adjustment. So that's something to be kept in mind. Now, if you take this as an example in case of a sole trader who has a business and a private use, so it's a little bit different because in case of a company, you claim the full deduction, and then if there is a private use, you make a fringe benefit tax adjustment. Whereas in case of a sole trader, you only claim the deduction to the extent of a business use percentage of that asset. You don't claim full and then pay tax, fringe benefit tax on the private use. So this example, if you are a sole trader, you have 60% use for business, then you apply that 60% limit to the luxury car limit. In this case, we'll give you a deduction of 35,482. So what if the value of the car is above $150,000? So then you go into two different categories here, and I'll explain that. One is the temporary full expensing, which I've just discussed, and the other is the accelerated depreciation option, right? And that could be the car or any other asset. But in this case, let's say if the value of the car was above 150 and you purchased it before 6th of October 2020, when the temporary full expensing law came in, that means you don't have the option to write it off fully. You'll go into an accelerated depreciation, which I'll explain in the next slide. But if you purchase this after 6th of October 2020, it doesn't really matter because it's then uncapped after that date under this new temporary full expensing, and you can write off the full value, again, subject to the luxury car limit. So now accelerated depreciation rules came last year as well, along with the instant asset write-off limit of 150. That's where the law allowed us that any asset which is purchased for the business above 150, which you can't write off under an instant asset write-off, then you can go in an accelerated depreciation, which is you claim 50% of the value of the asset in the first year, and then the balance goes to your normal general pool if you're a small business, or if you're not a small business, then it goes into your normal depreciation rates. So just quickly, the eligibility was that the business needed to be under a turnover of $500 million. And there's no limit on the number of eligible assets under this, unless the passenger vehicle designed to carry a load of less than 1 ton or fewer than nine passengers. So which is a luxury car limit. If you're above that 1 ton capacity, then it's not considered under the luxury car limit, and you can claim the full value. You know, whether even if you buy a truck, $500,000, or a big van, you know, you can write it off fully because it wouldn't classify under the luxury car limit. So the eligibility was in this particular case, the asset had to be new and not a second-hand asset, and needed to be ready to be used after 12th of March 2020 when the announcement was made, and before 30th of June 2021. Again, I mean, 6th of October has changed that. So if it's after 6th of October, you're not going to be looking at the accelerated depreciation. You can write that off fully, unless you want to opt out and you're not eligible to opt out. Then you can look at this as well if that suits you better. So again, if you have applied instant asset write-off of temporary full expensive, then this is excluded. You can only go into one of the categories, and the other one automatically excludes. So the second-hand asset, as I mentioned, are excluded. Div 40 asset, which is the low value and software development pool, building capital write-offs, which I mentioned again, fall under a 2.5% depreciation category. Some primary production assets and excess cost of the above the luxury car limit. So these are similar in all the three cases. Same kind of exclusions are generally applying in all the three categories. Again, you have an option to opt out on an asset by asset basis, and the same rules apply, that you should not be using the simplified depreciation rules, which is the general pool method, if you want to opt out. So let's look at a quick example for how the accelerated depreciation will apply. Let's say you're a small business with an aggregated turnover of less than $10 million, and you use the simplified depreciation rules, which is the pooling. So the assets over the instant asset threshold, which are eligible for accelerated depreciation, but not eligible for the temporary full expensive, you can add the balance to the general asset pool. And you'll see that in the figures below. So effectively, you get a 57.5% deduction in the first year, which otherwise in the normal simplified rules of general pool, you get 15% of the value of the asset in the first year. So it's still a decent amount of deduction you get in the first year, and you still have a value of the asset left in the pool to claim some depreciation in the future years. So in this example, you've bought a piece of equipment for $200,000, excluding GST, before 30th of June 2021. Now, no instant asset write-off is applicable in this case because the value is above 150K. But you may be eligible for the temporary full expensive, provided you bought it after 6th of October. So 6th of October has changed the dynamics altogether, but anything below that, then you're still looking at instant asset and the accelerated depreciation rules. So in this case, straightforward, $200,000 first year, 50% under accelerated depreciation, you get 100 grand, and then the balance of 100,000 goes into the general pool, which then goes on to the normal rules of 15% in the first year, and then you claim $15,000 on the remaining 100,000. So your total deduction for the first year is $115,000. And then you will have a balance of $85,000 left in the pool, which you'll carry forward to the following year. And then you claim normal 30% depreciation on that as part of the pool. Okay, so I have summarized this in a table form so that in a snapshot you can see how this all transforms. So basically, we're looking at 3 time frames here within this particular financial year, 2020-21. So if you bought an asset from 1 July 2020 before 7:30 p.m. 6 October 2020, and the value of the asset is under $150,000, you use the instant asset write-off rules and you claim full value. Now, on the same date span, if the value is more than 150, you go to the accelerated depreciation rules, and then you apply 50% plus 15% of the balance, which gives you an outcome of 57.5%. Now, if you go beyond that date, which is 7:30 p.m. on 6th October 2020, and before the 30th of June 2021 in this financial year, there's no limit on the total amount of the asset. You claim the full value under the temporary full expensing rules. So hope that makes it clear. I'm just going to have a quick look at the chat before I go to the next one, if there's any questions that have come in. All right, no, so no questions so far, so we'll move forward and go to the second strategy, which is contributions to the superannuation fund. So now, superannuation, as I mentioned, is one of the primarily an important aspect of tax optimization in the Australian tax system. And different people have different types of superannuation funds. As you would know, you have your normal retail fund or industry fund, or some of the businesses, they carry their self-managed superannuation fund. So either way, the rules are similar in terms of the contribution strategies are concerned and how you can minimize your tax. So we'll discuss about the contribution sort of provision. So there's 2 types of contributions you can make to a superannuation. You can make a contribution from your pre-tax income, and you can make a contribution from your post-tax income. So anything you contribute from your pre-tax income is classified as concessional contribution, which means you contribute from your pre-tax income. That means you claimed the deduction from your income, which reduces your taxable income, and you only pay tax on your income after the superannuation contribution has been taken out. So example, $100,000 income, you contribute $25,000, you'll be taxed at $75,000 as your taxable income or assessable income. Now, when that concessional contribution goes into the superannuation fund has to pay 15% contribution tax on it. So, which is called concessional contribution tax. And the superannuation pays that out of the contribution. So 25,000 goes in, the 15% tax, 3,750 is paid by the fund, and the remaining money is invested through your fund. Now, non-concessional contribution is where you want to enhance your superannuation balance. You want to put more. You're working on a retirement strategy, or or you want to boost your super. Now you've already reached. Why would you do non-concessional? Okay, you've already reached a concessional contribution cap, which is $25,000 maximum you can put it in a year, and you want to put more money into the super. That means then you have to go into a non-concessional, because you can't put more concessional beyond your cap. Otherwise, you get a concessional excess concessional contribution tax. So the limit for non-concessional contribution is $100,000. You don't get any tax deduction. So in this example, 100,000 income, 25 you put concessional, you're left with 75 on which you pay tax. Now from your post-tax paid money, you decide to put another 25 grand into the superannuation. That'll go as non-concessional. You don't get any tax deduction, and the superannuation fund doesn't have to pay any tax on it on the way in the super fund. So that 15% contribution tax that applies to concessional contribution doesn't apply to non-concessional contribution. So the limit for that is $100,000 per annum at the moment. Uh, both the limits are getting increased from 2022 year, but for now, 25,000 for concessional and $100,000 for non-concessional contribution. This sometimes you would make a non-concessional contribution even though you don't put or you have not utilized your excess contribution limits, and that could be where, let's say, your marginal tax rate is already sort of below 20%, or you are in a 19% tax bracket earning less than 30, 37, 39,000. uh, in that case, if you make a concessional contribution, you get a tax deduction, but the superannuation fund also pays 15% tax on it. So you haven't really got any arbitrage. There's no uh, basically benefit overall you've achieved. In that case, you might decide to put non-concessional contribution. It depends on the specific circumstances and what strategy and what are the benefits, whether you make a decision between applying a concessional or a non-concessional. But from tax planning perspective, that's very important. We're coming close to the June end. So if you need to reduce your taxable income, you have not utilized your full concessional contribution cap. If you are drawing a salary from your business, or you are employed uh, and you have not used the full concessional contribution limit of $25,000 based on how much has been contributed by your employer on your salary at the 9.5% SGC rate, you have that balance left to make a decision before June if you want to top that up. If your cash flow allows you and you want to reduce the tax, you can do that. So different type of concessional contributions, the compulsory employer contribution. So the employer pays that on your behalf on your salary. Any additional contribution which is reportable, so you can go over and above your normal 9.5%, which you can do that by way of a salary sacrifice. But now, as the law changed a year ago, you don't need to do salary sacrifice to make an extra top up. You can just pay it before 30th of June out of your own disposable income and still claim a tax deduction. So you don't have to go through your employer, which used to be the case that you have to go through your employer through a salary sacrifice process, which is not the case now. You can just top up yourself before the end of the financial year. So just be mindful that if you're looking to do that before 30th of June, you have to make sure that you do that well in time. The funds have to be received by your fund before 30th of June clearly in their bank account to apply that for this relevant financial year. Otherwise, you can miss that and they'll consider it in the next financial year. I've already discussed the limit will increase from 25 to 27.5 in the next financial year for 2022. All right, so now I've already covered the first point here, that you don't have to go for your concessional contribution extra top-ups. You don't have to go through your salary sacrifice process. And that's works as a good strategy sometimes if you have a capital gain or you're expecting some capital gain on the sale of a property um, close to the end of the financial year, and you have not allowed for that throughout the year by making a salary sacrifice through your employer. You can just quickly work out how much is the extra tax you need to pay on your capital gain property, work out with your accountant, and decide how much you can quickly top up before 30th of June, and you can reduce your capital gain tax liability to a fair extent, depending on the value of the capital gain and your balance contribution cap left. So that's a good strategy. Sometimes you can use if you sold a property or you've made some capital gains on the shares. So it's a good reason to top up. So we covered that the superannuation gets taxed at 15%. Now, if you're running a business through a company and getting taxed at 27.5%, then as the superannuation fund pays 15%, you get a net benefit of 12.5% in the differential tax rate because the company will save the tax at 27.5%. But this can go up to 30% benefit because let's say if the company is paying you dividends and or you're drawing profits from the company or you are employed and you are in a 45% tax bracket, then using the maximum cap for superannuation gives you a leverage of 30% because the superannuation will pay 15%, whereas you get a tax deduction at your marginal rate of 45%. You can save almost 30% of the entire contribution value. You'll be saved in the tax benefit. All right. So just a couple of more points here under the superannuation. Last year, a new provision was introduced, which is the carry forward of your unused superannuation cap. So if you've not used your entire $25,000 concessional contribution cap, you can carry that forward. Previously, it used to expire. Every year, you have a new $25,000 limit. You use it, otherwise it expires. So from 2019, 2020 was the first financial year where if you only use 20,000 out of your contribution cap, you've got $5,000 balance remaining, which you carry it forward. Next year's cap of 25,000 gives you a total of $30,000, which you can contribute. So some people who've not been using their full contribution caps and suddenly have a capital gain on a sale of a property or some higher income, that's a really good benefit that you can make extra contributions concessional to optimize your tax position. But the caveat there is that your overall balance in your superannuation as a member balance should be less than $500,000. So if you got more than $500,000 in your super, then you can't use that carry forward provisions. Now there is a government co-contribution available as well. If you earn less than $54,837, then government will co-contribute 50% of the amount contributed by you up to a maximum of $500. So if you contribute up to $1,000, the government will co-contribute $500 straight to your superannuation account, provided you're earning less than that. So if you're earning 38,564, you'll get the full $500, and then it scales down from 38. I think there's a typo there. From between those limits, it'll scale down from $500 to zero. So when you reach 54, it'll be zero contribution. So some more strategies. So strategy number 3 here, where some of the things you can apply in your business, and also even if you are an individual salaried person with sort of investments and stuff, you can still apply. And I'll cover a few different things here. First of all, a prepayment of the interest. That's available whether you running a business or you are unemployed with investment properties or other investments. So if you have an interest expense on any of the bank borrowings or any mortgage, you are able to prepay that for next 12 months in advance and claim the full interest deduction. So let's say before 30th of June 2021, you want to, so you paid the interest for this full year, and you've got some bonuses, or you've got some extra income in this year, and you want to reduce that. So you talk to the bank, how much is my interest on my loans for the next 12 months, for that 21-22 financial year. Tell them want to prepay that. They calculate, they work it out for them, and they give you a figure. Okay, here's $30,000 interest on your property loans for next year. You say, okay, I want to pay that now before 30th of June. So you prepay, you claim it as a tax deduction in the current year. Obviously keep in mind then the next financial year, you're not going to have any deduction unless you use the same prepayment cycle next year as well. So you have to be mindful that that this is not going to bite you in the later years, where if your income is continuously be at the same level. So it doesn't work if your income is going to be continuously at the same level. So this is when you have a spike in your income because of some sort of one-off sort of bonuses, capital gains, and one-off type of additional incomes. You then you can use that to minimize that in that particular year, and then it balances out later on. Also keep in mind that if you are in a fixed rate of interest, then it's you could have a break cost, because the banks will consider that as breaking the fixed rate if you if you decide to prepay the interest. So there's just something to be kept in mind. Yeah, so I've covered that. Okay, so I think we've covered most of the points here in this slide. All right, so where else can you apply these prepayment rules? So there's many other type of expenses in the business where you can apply these prepayment rules. So if you're a small business, you can prepay your rent up to 12 months. You can prepay your insurances. So there are certain expenses in the business you can prepay up to 12 months and bring forward the deduction in the current financial year, again to reduce your taxable income if you had a big year and you expect that to normalize in the future years. So you want to reduce that in the current year by applying that bring forwarding of the expenses in the current year. So just a little disclaimer there that the cash boost under the COVID, which the businesses got up to 100 grand per business based on the eligibility. Now that was treated as non-assessable, non-exempt income, which means it's not taxed in the hands of the taxpayer. So the business doesn't have to pay any tax on the cash boost they received. But if you have any losses in the business, just keep in mind that the cash boost will absorb those losses. So normally you will carry forward your losses to the future years and be able to offset that against your future income. But if you had a cash boost during the current year, your losses will be reduced to the extent of the cash boost you received, and you'll only be able to carry forward the remaining losses to the next year. So just be mindful of the anti-avoidance rules that you basically considering the deferment of the income in a legitimate way, which is so the deferment of the income sort of applies where you were expecting certain sales to be made just before the end of the financial year, and that has been delayed and deferred to the next year. So that's all right, unless you issued the invoice and then you try to defer that invoice itself from entering into your sales. But if you defer your sales legitimately, then that deferment of the income can be used as one of the strategies to reduce your taxable income. So again, I've just given an example there that if you receive an advance and deposit from a customer, but the goods have not been delivered, then you can easily, that deposit in advance, you don't need to book that as a sales.
until an invoice is issued because the delivery has not been done. So you can consider that advance as just an advance as a liability in your balance sheet. You don't have to consider that as an income. So all right, so we have so another point here is capital gains. So let's say if you have a high income in a particular year, and you're looking to sell some of your assets like shares, which are trading at a decent amount of profit. So just time it in a way that, I mean, if you already had a big year and if you sell an asset and have a big capital gain, then of course you are going to have a higher taxable income, which means you will go into a higher tax bracket. So the sorry, just 1 second. Yeah. So so just time it. So if you can, sell the asset in a subsequent financial year or just after 30th of June, so that it can be deferred to the next financial year where you're expecting your income levels to be slightly lower. That will give you a benefit. You might, fall under a lower tax bracket. So, but just one thing to keep in mind in case of a sale of a property, uh, for capital gain purposes, the date of signing the offer and acceptance or the contract is the relevant date. So let's say if you signed a sale of a property contract mid-June, but your settlement is happening in August or September, which is the next financial year, you that transaction is still considered for the current financial year for capital gain purposes in 2021. It's not it won't be considered in the next financial year based on the settlement date. It goes by the contract date. So that's something to be kept in mind if you're trying to time it well. And also, particularly in case of shares, or let's say if one type of an asset you sell which has a good amount of profits or capital gains, but you're expecting certain other assets to be trading at a loss. So if you don't want to hold that for a longer period of time, you might be better off selling some of those at the same time. So you materialize the loss at the same time in the same financial year, so that you can reduce your capital gain rather than selling all the assets with a profit first, and then next year you sell the assets with a loss, which then the loss will be just carried forward and won't be used. So if you have a loss before the profit, then you can use the losses against the profit. But if you have the profit before the losses and the financial year changes, you'll have to pay the tax on the profit in that particular financial year, and the losses go into the next year, then have to be carried forward. That's something to be kept in mind. So strategy number 4, which is writing off the bad debts and trading stock. So you can look at the change of the stock valuation methodology. So there are a few different ways you can value the stock: cost basis and market valuation. So you have an option to choose the cost or market valuation, and you adopt that based on whatever is the lowest. You can adopt that. So just it'll be wise to, if you have a decent amount of profit in the current year, and you have a lot of inventory, it's normally a good practice to just to value your inventory at the end of the financial year, or even sometimes do a physical count, because you could have an obsolete stock which you can write off. So try to assess the value of the stock, see what's the cost, what's the market value. If some of them are depleted, then you can always apply a market valuation rule to the stock to reduce the profits. Um, Sometimes you have a trading stock in transit. Let's say you placed an order to buy certain stock for your inventory. Now, if you have already received an invoice and you've entered that in your cost of sales, then you need to consider the inventory in transit as part of your closing stock, even though it has not arrived at your premises, because you're claiming an expense. Then the inventory in transit has to be considered as an income or as your closing stock to balance it out. Or the other option is that you don't consider the invoice as part of your cost of sales. You don't claim that because the inventory has not been received or delivered in your premises. Then you can exclude from both the sides. You're not claiming a deduction, and you're not counting the stock in transit as part of your overall inventory valuation. Obsolete stock I've just covered. If you do a physical stock check, then you can look at whether some of the stock can be written off, and you can claim that as a deduction. Again, look at your accounts receivable or sundry debtors list to see you have any debtors which have been sitting there for quite a long period of time, and chances of recovery are very minimum. So you can decide to write off. So to claim a deduction under the bad debts, you just need to make a decision that this is not recoverable, and you write that off in your books. That's sufficient to claim a tax deduction. It doesn't mean that you can't still make efforts to recover that. But if you end up recovering, or the customer ends up paying in the future years, then it'll be added back to your income. But to claim a deduction, you just need to make a decision to write off and write that off from your books. All right, so let's look at the time. Yeah, we 10:50. We're going okay. Any questions so far? All right, no, that's all good. If you have any, if anyone has any questions, feel free to type in the chat box, or we'll cover towards the end. Now, quickly, just the tax optimization by applying or under various business structures. Now, this is more relevant when you sort of running a business, not so relevant if you're just an employed on a salary. So we look at the three main sort of business structures under which the tax treatment is different, or the tax rate or the tax outcome is different. So let's say if you're running a business as a company, which at the moment has got the best optimum sort of tax rate, if the profit is taxed at the end of at the hands of the company itself. The current tax rate, which has been 27.5% for the small business entities, which is now being reduced to 26% in the current financial year. So 2021, the applicable rate is 26%, and which is going to be further reduced in the subsequent years as per the scale provided by the government. So now, some of the things you need to consider in a company. So the company will have to pay the tax on the profits of the company, and then you can distribute the profits after tax to the owners, which is called dividends. Now, most often you see that in businesses, the owner draws a wage from the company. So the wage is already claimed as a deduction by the company. So the profits of the company after the wages to the owner have been paid, then are subject to tax at 27.5 or 26%. Now, those wages which are received by the owner, of course, they are taxed at the normal marginal rates like any other individual. So depending on the amount of the salary, then which tax bracket you fall under. So if you've got $100,000 salary, you'll apply the normal marginal rates and you pay the tax on that. But the company claims that as a deduction, it pays the tax on the profit at 26% for the current year. Now, this you don't really have to pay the dividends out of the company every year. So that's one of the benefits in the company. You can retain the profits. So if you don't need more cash out of the company as an owner, you tend to pay the tax at a lower tax rate, which company is entitled to, and retain the profits within the company. Because when you draw those profits, then they will be taxed as dividends in the hands of the individual owner, but not double taxation because the company has already paid tax on it. So you only have to pay differential tax based on your marginal tax rate, and how much tax the company has already paid. So a simple example, let's say you already drawn $100,000 salary. Now the company, let's say, has a profit of $50,000 left after paying the salary. You pay tax at 26%. You know, let's just, for simplicity, the tax is $10,000. You got $40,000 left in the company. If you draw that $40,000 as dividends, then they will go in your personal tax return as dividends. You have to gross it up. So 40,000 pre-tax becomes 50,000. Your taxable income would be 100,000 salary plus $50,000 dividends. You calculate your tax at the marginal tax rates. Then whatever the tax is calculated, you get the credit for the tax the company has already paid on the $50,000 profit, which has been included in your income as dividends. So $10,000 tax credit, which the company has paid, will be passed on to you, and you claim that as from your total tax payable. So you basically in that case paying a differential tax above the rate of the company, and the difference between your marginal rate and the company tax rate, which could be, if you are in 45% tax bracket and companies pay 26, then you're paying another 19% tax. So you just have to decide whether is there a real need to draw the profits out of the company before the end of the financial year or not. So if you're operating as a trust now, in a discretionary trust or a family trust, you can't hold the profits. That's the main distinguishing feature. When we say that you can't hold the profits in a trust, means that for tax purposes, you need to decide whom the profits are going to be distributed. So if there are two husband and wife are the beneficiaries of the trust makes $100,000 profit, whether you pay a salary or not. You know, if you paid the salary, then the salary is taxed already in the hand of the individual, and the profit left in the trust is the remaining profit that needs to be distributed. Trust does not pay any tax on its profit, contrary to the company. So the trust will say, let's say I distribute 50,000 each to both the beneficiaries, so they will have to pay tax on it, and they can withdraw cash from the trust, of course, the profit distribution, to pay their tax, and the remaining cash will then go to them. But you don't have to take the cash out of the trust if the cash is being circulated in the business, and you only draw that much cash you need to pay the tax. So the distinction here is that you still distribute the profit from the trust to the individuals for calculating the tax, and the individuals pay the tax, irrespectively whether you take the cash out of the trust for that distribution of the profit. Whereas normally in case of a company, if you're paying dividends, you normally tend to pay the dividends in cash. However, you can always still distribute dividends, but leave that as a loan in the company. But without making it too complicated, the simple distinction is that in the trust doesn't pay tax. It doesn't have the facility of paying the tax at a lower rate of 27.5 or 26%. It has to divide the profit in the hands of the beneficiary, and they'll have to pay tax on it. So I'll quickly run into the third scenario, which is a partnership, which is a very simple, clear. So partnership, the profits get taxed in the hands of the partners. The partnership does not have a separate legal status as a company or a trust. So it's a partnership of two or more individuals. They do the business together. So the partnership still is a separate entity for tax purposes, has its ABN, has its tax file number. But again, whatever is the profit of the partnership, that gets divided in the hands of the partners, and they have to pay tax in their personal tax return. So very simple process. So it's very relevant for you to decide the appropriate business structure if you want to understand what's the most suited in your circumstances and based on the level of income you are earning. So that was the main 5 strategies, which kind of gives you hopefully some sort of tools to apply in your personal situation before 30th of June. We're running out of time, and I'll allow a few minutes. We might go a little bit over for a few minutes if we have any questions, but I'll take 1 minute to just give you quick updates on some of the recent new law tax changes that will apply for the current financial year. So the marginal income brackets have changed for 2021, and they'll be changing in the future years as well. So that's a good outcome for this financial year if you're planning your taxes. If you were under $37,000 paying 19% tax, and above 37,000 you were paying 32.5% tax, that 37,000 has been moved to 45. So that means if you're still under 45, you'll only pay 19% tax. So that, that's almost $8,000 additional you earn without having to pay 32.5% tax. Similarly, anyone who was earning up to 90 can now earn up to $120,000 and still pay 32.5% and don't go into the next tax bracket of 37%. So another good loss carryback measures in the companies, those who are running a business in a company, you from this particular financial year, you have a facility to carry back your losses. So let's say you made a profit in 2019 financial year, $100,000, you paid tax of 30%, $30,000. Now in the current year, your business ended up in a loss. COVID, whatever reasons, you made a $50,000 loss. Now, generally, in previous situation, you will have to carry forward that loss into the next year and wait till you make profits to be able to use those losses and reduce the tax liability for your future years. But under this provision, if you have a loss, you have a cash flow problem, you in your 2021 tax return, you claim that loss against the prior year's profit and get a refund of the tax you paid in the previous year. So very good provision, but you have to be running a business as a company. So, it really helps in getting your cash flow by way of getting the tax back from the ATO, which normally is not as simple to get the money back from the ATO. A few little more updates. Some of the startups. I won't go too much into detail, but any startup between $10 to $50 million turnover, they've got some accelerated write-off of the expenses, some startup expenses, prepayment expenditure. You can claim all that, which were not available in earlier. From 2022, there are some more rules being simplified for the startups. Simplified trading stock rules, GST rules, 2-year amendment of the tax return provisions, and few more things which may or may not apply to a lot of people attending today. And quickly again, the superannuation caps, which have increased from 25,000 to 27.5 for concessional, and from 100 to 110 for non-concessional. And also your general transfer balance cap, as some of you would be aware, $1.6 million balance cap, which has been increased to 1.7 million cap. So where you can make contributions if you go up to a $1.7 million general balance cap. So that's pretty much for today. Hope it has been valuable and has given you some good tools and strategies you can apply before the end of the financial year. If anyone has any questions, please feel free to type on the chat box. I think there's a question come up on the Q&A. I'll quickly look at that. Dinesh, I transfer $100 fortnightly into an investment company and they invest into share portfolio. I'm considering withdrawing some of the money, but unsure what the tax implication would be. So pretty much, so if you are investing $100 into an investment company, so let's say I'm assuming that investment company is like a fund, they are investing in a shared portfolio. So the money which you are investing, I presume that is from your own capital, you have not borrowed. So there's two different ways to look at it. So first of all, let's assume that's from your own savings, your own capital. Then that means that has become your investment in a shared portfolio. You need to wait for the dividends. So your income would be in the form of either dividends from those shares, or you sell the shares and you make a profit. So the dividends you receive, they are taxed in your hands. So that will go into your tax return and you pay a normal marginal tax rate. And if you withdraw by selling the shares, so when you're looking to withdraw, so it could be either in the form of dividends being withdrawn, which is taxed normally, or you selling those shares and you withdrawing your capital back, which then you have to see whether there is a capital gain on the sale of the shares. And if there is a capital gain, you calculate the tax on the capital gain. If you held that for more than 12 months, the capital gain gets reduced by 50%, and then you calculate the tax. But if you withdraw or sell under 12 months, then you have to pay on the full value of the capital gains. So I hope that answers that question. Um, uh, let's have a look if there's any more question. All right. Well, I don't think we have many more questions, but if anyone has any other questions, feel free to reach out to us. We've got our contact details there. We've got a phone number, our email. Feel free to give us a call or reach out to us by an email, or even if you're a WBA member, feel free to reach out to Lauren, and she can direct the questions or query to us. So more than happy to help and assist any of our members. So thank you once again for joining. We will have the recording of this. The session has been recorded, so the recording will be available. If someone has missed it, the recording will be sent to Lauren, and she'll make it available for the members if anyone wants to watch it. Thank you once again, and all the best for the financial year ending in your business, and hopefully you guys can plan well in time to get the best outcome. Thank you, and all the best, and see you soon.